Warren Buffett's 7 timeless investment rules are essential for anyone seeking financial success in 2024. But do you know what makes these rules stand the test of time? In today's video, we'll delve into the timeless wisdom of Warren Buffett's 7 investment rules, guiding you on a journey toward financial success in 2024 and beyond. These rules aren't just about numbers and charts. They're about the human emotions that drive our decisions in the unpredictable world of investing. From the fear of losing money to the greed that tempts us to chase quick profits, Buffett's rules offer invaluable insights into navigating the roller coaster of emotions that accompany market fluctuations. So, let's dive in and explore how these rules can help us make smarter, more disciplined investment choices, empowering us to achieve our financial goals with confidence and clarity. Rule 1. Don't lose. At the heart of Warren Buffett's investment strategy lies a simple, yet profound principle. Don't lose money. While this concept may seem straightforward, its implications are far-reaching. Buffett famously stated, "The first rule of investment is don't lose, and the second rule is don't forget the first rule." This emphasizes the paramount importance of preserving capital above all else. By prioritizing the protection of their hard-earned money, investors can mitigate the risks associated with market volatility and economic uncertainty. Buffett's sage advice underscores the significance of avoiding reckless speculation and instead focusing on prudent risk management practices. Buffett's emphasis on capital preservation serves as a timeless reminder to investors to prioritize risk management, particularly during turbulent market conditions. By carefully evaluating potential investments and avoiding those with uncertain outcomes, individuals can safeguard their financial well-being over the long term. This approach not only helps investors avoid significant losses, but also lays the groundwork for sustainable growth and wealth accumulation. Rule 2. Invest in what you understand. Warren Buffett's emphasis on investing in businesses that one understands resonates deeply with the human experience of seeking security and familiarity. When investors stick to what they know, they feel more confident and empowered to make sound decisions. This approach not only reduces the anxiety associated with uncertainty, but also instills a sense of control over one's financial future. Moreover, by focusing on familiar industries or companies with transparent business models, investors can develop a deeper emotional connection to their investments, fostering a sense of trust and loyalty that transcends market volatility. In essence, Buffett's rule reflects a fundamental human desire for stability and certainty in an ever-changing world. Rule 3. Think long-term. Warren Buffett's wisdom extends beyond mere financial advice. It speaks to the very essence of human emotion and psychology in investing. His timeless rule, "Be greedy when others are fearful, and fearful when others are greedy," highlights the role of emotions in driving market behavior. During times of market exuberance, greed often leads investors to take excessive risks, while fear can cause them to panic and sell at the worst possible moment. Buffett's insight encourages investors to remain rational and contrarian, capitalizing on opportunities when others are hesitant and exercising caution when optimism runs high. This approach not only requires discipline, but also a deep understanding of one's own emotions and biases, a crucial aspect of successful investing. Rule 4. Always buy below. Intrinsic value. Warren Buffett's emphasis on buying below intrinsic value taps into a fundamental human desire for a good deal or bargain. Just as individuals seek discounts or sales when shopping for everyday items, investors are naturally drawn to opportunities where they can acquire assets at a lower price than their actual worth. This strategy not only appeals to our sense of thriftiness and prudence, but also reflects a pragmatic approach to investing. Moreover, buying below intrinsic value instills a sense of confidence and satisfaction, knowing that one is getting the most out of their investment dollars and maximizing potential returns in the long run. In essence, Buffett's rule speaks to our innate inclination to seek value and make prudent financial decisions that align with our goals and aspirations. Rule 5. Be greedy. When others are fearful. Warren Buffett's advice to be greedy when others are fearful resonates deeply with our human instinct to seek security and stability in times of uncertainty. It acknowledges the fear and apprehension that often accompany market downturns while encouraging investors to act decisively when others are hesitant. This rule speaks to our innate desire for self-preservation and financial well-being, urging us to overcome fear and seize opportunities for growth and prosperity. Furthermore, Buffett's emphasis on remaining fearful when others are greedy highlights the importance of humility and prudence in navigating market euphoria. It reminds us to exercise caution and restraint, even amidst prevailing optimism, to avoid reckless decision-making and preserve our hard-earned capital for the long term. Rule 6. Be patient and vigilant. Warren Buffett's emphasis on patience and vigilance strikes a chord with our innate human tendencies and emotions. In a world where instant gratification often dominates our decision-making processes, Buffett's call for patience serves as a gentle reminder to resist the allure of quick gains and instead focus on long-term success. It acknowledges the emotional struggle of waiting for investments to mature, while highlighting the importance of disciplined perseverance in achieving financial goals. By urging us to stay vigilant, Buffett acknowledges our need for security and protection, encouraging us to remain alert and proactive in managing our investments. This rule underscores the significance of staying informed and responsive to market changes, ensuring that we are prepared to seize opportunities and navigate challenges with confidence. Furthermore, Buffett's wisdom speaks to the human desire for stability and certainty in an uncertain world. His insistence on patience and vigilance resonates deeply with our instinctive need to safeguard our resources and protect our financial well-being. Rule 7. Avoid cigar butt. Investing. Warren Buffett's aversion to cigar butt investing stems from his belief in the importance of quality over quantity. He understands the allure of picking up cheap assets in the hopes of making a quick profit, but he also knows the risks involved. Buffett warns investors against falling into the trap of short-term thinking, emphasizing the importance of focusing on the long-term sustainability of an investment. It's like choosing between a quick sugar rush and a nutritious meal. While the former may provide instant gratification, the latter offers lasting nourishment. Instead of chasing fleeting opportunities, Buffett encourages investors to seek out businesses with enduring competitive advantages and robust fundamentals. This approach may require patience and discipline, but it ultimately leads to more consistent returns over time. It's akin to planting seeds and patiently nurturing them as they grow into strong, fruitful trees. By investing in high-quality businesses at fair prices, investors can build a portfolio that withstands market fluctuations and delivers sustainable wealth accumulation in the long run. Warren Buffett's 7 timeless investment rules offer invaluable guidance for investors seeking to navigate the complexities of the financial markets. By applying these rules diligently and adapting them to suit individual circumstances, investors can build a solid foundation for wealth creation and achieve their long-term financial goals with confidence. Thank you for joining us on this exploration of Warren Buffett's investment rules. We hope you found these insights valuable and actionable as you navigate your own investment journey. If you enjoyed this video, don't forget to like, share, and subscribe for more content on investing, finance, and personal development. Until next time, happy investing!